Hey everyone, welcome. Ezra Roizen with Advisor, and thrilled to be here at Haas, thrilled to be part of the lifelong learning effort. Go Bears. This whole program was something that the alumni group and I and a number of others participated in getting started almost a decade ago. How do we use social media? How do we bring Haas content and knowledge and community both to the fore and together? And it's a great example of the strength of the Haas network and also the value of being part of the Cal and Haas community. So this is terrific to be part of this, and also to sort of seeing this now come to the fore because it's a great platform, and I'm thrilled to be here. So the topic I wanted to speak on, and I was invited to speak on, is Magic Box Paradigm. I wrote a book late last year, or I wrote it last year, but it was released late last year, called Magic Box Paradigm, and it's for entrepreneurs and focused on generally startup M&A and acquisition. And it's a framework and a way of thinking and a bit of a DIY guide for how to go about helping entrepreneurs think about and approach what's a bit of a under-discussed topic, where lots of folks have sort of bits and pieces, but they don't necessarily have accumulated a large sample size of experience. And in my practice and our team's practice over years had developed a way of doing things that wanted to share through the book and want to talk about here. The Magic Box Paradigm is not specifically a linear, here, this is how exactly you go about doing it. So I think that it's a set of concepts. And to that end, the challenge is when you're talking about a book or trying to present a book is that, it's a book. And this presentation is a subset of those concepts that I believe are some of the most important ones. The book's available for like $9 or something on Amazon on Kindle, so it's easy to get. If you'd like to read more, read that. But this is a abstraction of some of the key concepts that I thought would be helpful for entrepreneurs and give a starting point for thinking about mergers and acquisitions and acquisition as sort of a process. So I don't get too deep into the sort of backstory on the Magic Box Paradigm itself, but at its core, the notion is that startups are not a fixed asset. That particularly an earlier mid-stage startup in a product development mode is something that the value of which is found in the hands of who's holding it. And so sometimes when an acquirer looks at a startup and they look inside of what it may be to them, it can be gold coins. Sometimes it may be something of some value, maybe silver coins, and sometimes it may be something ultimately that isn't going to yield a huge amount of value. So the value of the asset itself is in relationship with who's across the table and whose hands it's in. So, bit of a backstory. We early last year sat down and thought about if we were going to approach startup M&A optimally based on 10, 15 years of experience in the business, what would be sort of the first principles? So it's nice sometimes, and I'm sure many of the folks on the feed have spent a long time in their career, have seen many things go right, have seen many things go wrong. At maybe the decade, 15-year mark, you sit down and say, what's really worked well? When have things gone well, and when have things gone not so well? And if we could construct a reality around the things that have gone well, what would that reality look like? And so the backstory for the book is, after that same amount of time, I sat down and started to jot down what are the pieces and elements of startup mergers and acquisitions that, when things have gone well, what were sort of the constituent components of that? And when things have gone not so well, what did things look like? And what were the behaviors and dynamics that happened in those situations? And so the book is a progression of how to avoid some of the pitfalls and how to optimize for some of the things that worked well. And then, interestingly enough, my wife actually has had to, over the last many years, sit through an endless number of phone calls from friends of friends and friends of friends of friends who are going through startup acquisitions and mergers and being acquired and acqui-hired and all kinds of stuff. And she finally said, man, you really should write this stuff down. So the converging pressure of, hey, you should really just write this stuff down so people can read it, and trying to think through how to do it right, was essentially the sort of genesis of the book. So let's dive in and start thinking through some of the concepts. As we and I sat down, my advisor is we, my team, we sat down and thought about what are the elements of a startup strategy. If you think about sort of in going to business school at Haas, you have sort of Porter's 5 forces. In startup land, you really have 3 core dynamics at work. The first is the product. What are you building? What's the innovation? What's the body of work you're developing? What path are you blazing? How are you solving needs for customers? How are you getting to know what their evolving needs are as well? So you're usually startups are really strong on product. There's distribution and thinking through how do you get your product into customers' hands. And it may be old school distribution. It may go on a truck and get put on a shelf, or it may be SEO and inbound interest, or it may be a partnership. It could be lots of ways that distribution happens, but ultimately the second challenge is how do you get it out into the world? And that's the sort of second force that you contend with as you're getting a startup off the ground. And the third is monetization. How do you actually make money? And these things aren't sequential. They're actually all swirling at the same time. So you make decisions that enhance distribution at the expense of the sophistication of the product. You may make decisions that enhance monetization at the expense of distribution. You may make a lot of decisions along the way of designing your strategy that are interplay between monetization, distribution, and product. All 3 of those things are going to be working all the time. And so you have to decide which trade-offs you make to get the startup off the ground. If we posit a second dimension and we think about how do you get the resources for growth, it could be raising capital, it could be through partnerships, and it could be through acquisition. So raising capital, the thesis basically being, I can figure out my product, I can figure out my distribution, I can figure out my monetization. All I need is cash. And if I get the cash, I can funnel it into the system, I can add the resources, I can add the team, I can build out the models, I can profitably acquire customers. My cost of customer acquisition is going to be much lower than my customer lifetime value. Those unit economics are going to converge. I'm going to have a highly profitable model in the long run. I just got to sort of go through a J-curve of getting some money in to build out that model. All I need is your money. Everything else I can figure out. That's the raise capital narrative and thesis. Partnerships. I have a great platform and product. I can effectively collaborate with other organizations that maybe have the customer reach that I would like. I can think through and create collaborative dynamics that will enable us to have better products together than we might apart. I can combine the revenue models and profit models and share the rents, if you will, from the relationship, reasonably and in a way that's determinable. And I can essentially freeload, if you will, on the infrastructure and commercial scale of a partner organization. That's another way that means you may require less capital and means you can get your product out and into the world more effectively sooner. It may unlock lots of other opportunities. The challenge with partnerships is, I'm sure as many folks in the feed would agree, they're just complicated and hard, and they're not clean, and you have lots of questions about who gets what from the relationship, and partnerships are just tricky to make work in the long run. Sometimes they can be great, but sometimes not so much. And then acquisition is another way of accumulating resources. It's sort of almost the combination of capital and partnerships. You can merge together. You can get rid of all of the relationship friction in a partnership. You can potentially get access to additional resources. You can definitely get access to the channels and dynamics that will enable you to grow faster. And essentially, you can accumulate the resources you need much more rapidly and in a much more free-form way in acquisition. So raising capital, establishing partnerships, acquisition, the frame of reference is all about how do I get the resources to get this new innovation more broadly into the world. And so if we think of the world that way, we think of really a startup acquisition as an entrance, not an exit. The term exit is sort of everywhere in our business. But ultimately, if you think about a startup, it may be an exit when it gets acquired for certain people on the cap table, and it may not even be that, because they may end up trading stock for stock. We've done lots of deals that are deals with emerging high-growth private companies where It's, even the people who invested aren't exiting. They're just trading one kind of equity or security for another kind of equity or security. So the frame of reference for entrepreneurs is thinking about a startup not as an exit, not walking in the room thinking, how do I sell this person something that I'm going to basically be walking away from or walking out the door. It's really thinking about and approaching the mindset as this is an entrance. This is a way for me. The conversation I'm having here isn't I'm trying to sell you something, but it is how can I essentially collaborate with whomever you may be across the table to have this opportunity reach its full potential. What's the highest and best use of this asset or this emerging asset we're developing in this company, and how do we get there? So what we recommend to our clients and the companies we work with in our investments is don't enter the room saying, hey, I'm here for this outcome. Don't have it be outcome driven. Enter the room with strategic partners, with investors, with whomever, with potential acquirers, with potential strategic partners, with what's the best way for us to take advantage of each other's strengths, and how can we create a relationship that's going to be most productive for both of us, and how can we leverage the resources we have and the resources you have to achieve something bigger. And if you approach things that way, you'll unlock a much wider range of potential conversations to have, a much wider range of potential outcomes, and you'll feel more comfortable, frankly, in the conversation. I know a lot of startups are like, well, I don't want to go talk to them because they'll think I'm for sale or I'm this or I'm that. And the reality is, everybody's sort of for sale. Everybody's not for sale. Everybody's trying to find how they can grow. There's nothing wrong with being an emerging company and trying to find resources for growth in whatever shape they may take. And if you take an open mind to how you approach the conversation with investors, strategic partners, and so on, you'll find, frankly, that both the conversation's easier and the number of potential outcomes becomes wider versus narrower. So this is a bit of a groaner. Startups are bought, not sold. Companies are bought, not sold. People hear that and they're like, oh yeah, I've heard that 100 times, and that's not helpful for me because I need to make actionable strategies and decisions for growth. But it's a really important concept, and we're going to unpack it and hopefully not make it a groaner, but actually make it something interesting. And why is that startups are bought, not sold? What does that mean? And it's not a sort of statement of resignation that there's nothing you can do about it. It's sort of external to you. It takes external forces to come together for you to be acquired. There's a great deal you can do to create an environment where you're attractive to suitors without having to sort of sell and push and clobber away at them to see the world your way. There's actually a method to the madness with this, and I want to dig in on it. But first, let's unpack the concept of bought and the concept of sold. We'll start with the concept of sold. So I use a simple example that people are generally familiar with when it comes to selling stuff. I mean, ultimately, we're here to talk about mergers and acquisitions and a transaction. So let's talk about transactions. Real estate, or if you think of a house, real estate is sold. And let's walk through the dynamics of that. You can sell something when you can present the same offering to the market. You can provide guidance on pricing, and there's typically a relatively narrow range of values. If you get multiple interested parties, you can run an auction to find the incremental improvements you can make in price. If there are ways to get the buyer increasingly committed to the transaction. So think in real estate, when I'm going to buy something, people don't take my word, or I don't tell the buyer to do me any favors. I actually take their word for it. I have the buyer give me a deposit. I actually take money. I increasingly bind them to the transaction. When you buy a real estate, essentially the seller is gaining power in that transaction as the transaction moves forward. So they're basically narrowing and driving that transaction to close with a significant power shift on the seller side versus the buyer side. And I can quickly close the deal. It's a known transaction. There may be little hiccups that happen along the way, but the steps to closing the deal are pretty straightforward. It's a transaction that happens all the time. It's highly structured. And so even just the process of closing is pretty straightforward. So you can sell stuff. In the back of your mind, I can sell something when I can present the same offering in the market, provide guidance on pricing. If I get multiple people interested, I can run an auction. I can get the buyer increasingly committed to the transaction and move them towards close, and there's a structured process for closing the deal. Startups are a completely different kind of asset. And so let's look at that same list and compare it to startup dynamics. First off, if we think about, and this is in the book, I think about the magic box paradigm, the asset itself may be very different depending on whose hands it's in. If I'm a company that has 1 billion users and your innovation can enable me to make another $1 from each, then maybe I can argue there's a $1 billion valuation. If the same kind of company only has 10 million users and you can enable me to make $1 from each, that asset maybe only has $10 million valuation. If the $1 billion company isn't interested in talking to you and the one that has the 10 million is interested in talking to you, it's a very different valuation profile. And so the notion that you can sort of present the same offering, solution, economic opportunity to the market, just it's not feasible. It's not a piece of real estate that has sort of directly related comps. It depends on who's looking at it, what the value is. So it's very hard to present exactly the same offering to the market. Because of that, it's also very hard to provide direct guidance on price, because what is optimal from a pricing standpoint is directly the context and result of the context of who's across the table from you. Because of that, because of the wide range in pricing, it's very hard to run an auction. Not saying impossible. You can do there are cases where you can do bidding wars. You get multiple parties interested and sort of incrementally drive up price. It happens every day. But it's very tricky. It should be handled very carefully and can backfire in lots of ways when it comes to startups. I won't go into all of them now, but these transactions are very nuanced, and you can upset the apple cart with aggressive competitive dynamics. It can work, has to be handled very carefully. Generally, I would say it's very tough for startups to run an auction. Fourth, startup acquisition dynamics are massively skewed in favor of the buyer. Whereas in real estate, or we're selling a house, or wherever, you're getting deposits, you're moving people down a path to close, you're increasingly binding them to the transaction. Complete opposite in our industry. I think a little bit ridiculously so, and frankly unfairly so, but the power has shifted generally on the default to the buyer. Buyer comes in with a very loose term sheet with high-level economic terms. It comes with it a 45 or 60-day exclusive period where you can't, as the seller, as the startup, negotiate with any other party except for them, and they can do whatever they want. They can change the deal. They can walk away. They can decide they want to evaluate 3 other things in parallel. They can essentially dictate how the game plays out. So the power shift in startup acquisitions is massively flipped to the buyer from when you're regularly dealing with a transaction. And then closing the deal. These things are incredibly complicated to close. You got to deal with all the team dynamics. You got to deal with technology. You got to deal with due diligence. You got to deal with the IP. You got to deal with how the customers are going to work. Maybe the buyer doesn't want all the customers you have. Maybe the buyer discovers that they don't like certain dynamics of the business. You have to then go through due diligence. You have to do a code review. You have 1,000 different things you got to look at that take weeks and very often months to complete a transaction. So once you get to even basic economic terms, the journey of getting to close is in and of itself an adventure. And I say in the book, I would say generally getting to economic terms means you're about halfway to getting a deal done. About 50% of the deals that get to basic parameters of economic terms don't close. That's amazing. 2 companies came together. The management teams agreed they should be together forever. They actually worked out what the dollar value should be. They figured out what this deal should look like at a high level. They agreed on that in some sort of term sheet or LOI. Still, only half actually close. In basically in my broad sample size experience, I'm sure other people have seen different, but a lot don't close. So I think the question becomes, for understanding that, is that has implications all the way up the stack. So understanding these dynamics is actually really good, because you can actually turn all of these factors in your favor if you approach startup acquisitions in the right way. So if you don't approach them like selling, I used the example of popsicles in the book, popsicles or real estate or transactions that are straightforward, but you appreciate the idiosyncrasies of startup dynamics, you can change the way you do the steps. You can advance due diligence to get the buyer deeper into the process sooner. You can not go into an exclusive LOI, or if you go into one, you can go into one that has a schedule on it, so the buyer is moving at a consistent tempo. You can develop their thesis. You can manage each conversation differently, understanding that you're not trying to play apples to apples, but you're dealing with apples and oranges. There's a lot of ways to rearrange the dynamics of the process in order to give yourself leverage and take advantage of the idiosyncratic nature of startup acquisitions and not get caught up in the trap of treating them like they're other kinds of transactions. And a lot of that is described in the book. So if you're intrigued at this point, it's a good thing to flip through that as well. So let's take a step back. And I also want to do questions here at the end. So I'm going to do another 15, 20 minutes, and then we'll do some questions. So one of the first parts of understanding all of this in frame of reference is understanding that most startup acquisitions are directional. And what I mean by that is they're not buying you for what you do in and of itself in its entirety. It's not like buying a sandwich shop on the corner that is a sandwich shop and will be a sandwich shop, and maybe you'll add coffee, but it's going to essentially be a sandwich shop. They're buying you because you are a component piece of a larger strategy that they have figured out and that they want to take advantage of as the acquirer. You fit into something that's a directional strategy for them, and they have determined that acquiring you is the most effective and fastest way to get them down that path. So first, to getting your sort of batting stance right on this is understanding that it's not what you are in and of itself, it's what you mean to them and their directional game plan. And that has significant implications because essentially, as you boil down where value comes from, in this slide, this is a very simple equation that I think you'll find helpful as you think about framing your company. The way they'll value you inside of that direction of theirs is twofold. First, it's opportunity. So what's the overall opportunity, as we talked about before with the two different companies that could share value with you? So what's the opportunity that they see? Maybe you've gone in and you've helped them learn and convince them and develop the conversation and narrative around $1 billion opportunity, but they see 10 different ways that they could accomplish it. So now all of a sudden, you're divided by your scarcity. So startup valuation isn't from a comp sheet. It's not from so-and-so got a deal done. They're really similar to us, but we're twice as far along, so we should be twice as much. All these sort of valuation narratives you hear. Valuation for a startup is opportunity divided by scarcity. So if they believe that you are the only group that could accomplish this, and then your platform is so far along, and your team is the world-class player in this, and you're going to help them get way down the line fast, then your scarcity number will drop, your denominator will drop, and it may be 1. And so if it's $1 billion opportunity and scarcity equals 1, then it's $1 billion. But your scarcity value quickly diminishes valuation as it gets bigger, as they perceive there's lots of ways to solve this problem. Thank you for showing us the way, but we don't need you. We can buy your competitor, or we can hire a team, or we can build it ourselves, or we can license this technology from this other group, or we can MacGyver together whatever we feel we need to do to get something done. Valuation is essentially their perception of what they believe the opportunity is divided by the scarcity of how hard it is for them, they believe, to achieve that outcome. So, if we go back to the directional nature of startup acquisitions, they're driven by a big idea. But it has to be their idea. It has to be an idea they have that fits into their strategy, that fits with their organizational culture, that fits with their vision of how the world is going to unfold, but into which you fit as a critical component of fulfilling whatever the direction and strategy is they're trying to fulfill. So it has to be a big idea, and it has to be their idea. And those are really the two hurdles as you think about how you're going to engage in dialogue with strategic partners, how you're going to engage them in conversation, how you're going to get them to participate in that discussion. And there's a couple key components to that. Narrative. The narrative, there's two dominant narratives that startups have. The first dominant narrative we talked about before is raising money. When you go see a venture capitalist basically has one tool. They have cash. They don't have distribution channels. They don't have ways of monetizing. They don't have established partnerships. They don't have additional human resources typically that they can sort of throw at your organization. They can't offload burdens from you and enable you to flourish and grow faster. They can give you money, and you have to go and do all the rest of it yourself. So when you go and present to a venture capitalist, you present with everything figured out. All I need is your money. I can do all the rest of it. Here's my product roadmap. Here's my unit economics. Here's my strategy. Here's my distribution. Here's my product. Here's all the pieces figured out. The other dominant narrative startups have is the one they have for customers. So here's our product. Here's the features and benefits. Here's the strengths. Here's why it's going to solve your problems. If for some reason the product doesn't match what the client needs, either it's in the product roadmap or the potential customer is dim-witted. So the reality is that you have a complete narrative there as well. When you go to strategic partners, you're ultimately trying to help them develop their big idea and have you fit into it and be perceived as directionally relevant, perceived to have a big opportunity, and perceived to be scarce. And you want them to have a big idea into which those things fit. So you want to uncover what their distribution dynamics are. You want to uncover what their product strategy is. You want to uncover how you could fit into it. So having all the answers actually narrows and kills the idea formation that you're trying to create. You're trying to create that light bulb. So if you go with everything figured out and you start the conversation, hey, I got this figured out, hey, I got this figured out, hey, I got this figured out, you will not have the optimal conversation, which is what can we do together? Where's the world going? What's important to you? How can we help you down that path? So there's a third narrative that is important for you to develop. And again, it's outlined in the book, a high level kind of DIY version. But for how you have an open-ended conversation and facilitate an open-ended conversation versus a venture capital conversation, which is typically relatively closed-ended, and a product conversation, which is pretty closed-ended. Third narrative, open-ended. So what you're trying to do in all these open-ended conversations is create inbound interest. So back to the backstory, I talked about when had things gone right over the last many years? Things generally had gone right when the people were coming to us. When we were trying to go to them and push them to see the world our way and trying to sell them and trying to convince them and trying to cajole them and trying to create constraints and get them to move faster, it just didn't work as well as when people came to us. So the game is understanding how the frame and how the model works and doing all the things to create an environment, an ambient environment where people are coming to you. It doesn't mean you have to take the deal. Don't necessarily take the first deal. Don't take the second deal. Don't take the third deal. But have opportunity. Have people come to you. Be in the conversation, in the flow, and be in a position where you're having opportunities you can turn down versus waiting until you got 90 days of cash in the bank and then deciding you got to spin them up fast or some other constraint. So, to entrepreneurs, and the book is written for entrepreneurs. I'm sure there's some investors or attorneys or other folks on the line here, but ultimately this book was written as guidance and advice, that same style we give to our clients when we're working with them, but written for the entrepreneur. And I would say the number one thing to do is start these conversations early. Don't start at the end, start at the beginning. As soon as you have a vision of where your company is going, start to develop conversations. It doesn't mean you have to be out pitching your company. It could be, hey, I want to talk to you about the way the market's going. I'm writing a blog. I want to be in a dialogue with you. But get to know the companies and people at those companies that matter and that are relevant to your strategic direction, because that will enable you to have a fertile soil of relationships that maybe generate inbound interest, but worst case, later on, if you need to maybe activate them a little more aggressively, they know who you are, they know what you're working on, they know what you're doing. Again, you don't have to spill your guts on your IP, but you do need to be on their radar. And you need to start like 2 years in advance, not 2 months in advance. Because if you think of it this way, simple graph. I decided to break the world down into two main buckets, you and them. If you determine that the greatest economic opportunity is in collaboration, that's a determination at some point in the history of your company that you realize that at this moment, if I look at my economic opportunities, the best outcome and the best way for this to achieve its full potential is in combination. Finding the right time for that to happen has to then align with them. Strategic alignment on direction and acquisition thesis. Do they believe that what you have is relevant to them. And in fact, this business is much more buyer-driven than it is seller-driven. They're not investing in you to have something great happen like a venture capitalist is. They're buying you specifically to have this happen, or something very narrow, they think. And that's a tough thing to call and a tough thing to time. So those circles are overlapping and shifting around and moving all over them like this. What's our strategy? What could solve our strategy? What are our priorities? Should I just stay independent? Should I raise some more money? Should I build another product? And so when those things converge, you want to be prepared in that magic moment to act. And so I have 5-10 more minutes. I wanted to walk through a couple more concepts. And again, this is sort of for founder, CEO, CXO, advisor. This is for really oriented towards the operators of the business. There's other thoughts maybe for just people who are purely board members and investors. Maybe that's another talk. But this is really for people who are kind of directly involved in managing the startup. So as we said, know your strategics. Know who are the companies that are relevant to you. And don't just know the companies, get a sense for who are the actual people. And it's not the corp dev person, although that's very helpful and useful to know them. It's the product people. It's the people who are mentioned in the press releases. It's the people who are in the dialogue around what's happening at the industry conference that's relevant. It's people who are actually thinking through the industry trends and questions that are relevant to your company. Know them and know who they are, and develop occasions to be in conversation with them, because ultimately these things are derivatives of their vision and their idea, and you again fitting into that. Back to starting early. I think we all get the concept of how important deal flow is. Customers, investments, whatever it may be, deal flow, having a selection, a numbers game of opportunities to select from, to engage in commerce is really important. Having cash flow, we get the concept of cash flow. So having money coming in and knowing how to optimize that and leverage that and balance it, we all get that concept. I'm going to add a third dimension here, is sort of strategic flow. The concept that there are relationships that you should have and that should be coming through that are conversations, ideas, new visions, market-changing confluences that you can essentially have as part of your strategic thinking. Have a slide in your board deck that is not just customers and MRR, ARR, and LTV, but strategic opportunities that we've talked to or thought about or considered or have conversation with. We're talking to these companies that are major players. It doesn't need to be hundreds, it could be 5. But we're developing these relationships, and we have a flow of conversations that have strategic relevance for us, corporate development relevance for us, versus just commercial relevance. That discipline and habit will get you thinking on the wavelength of folks who are in the acquisition pool. And maybe you never activate that, or maybe it becomes really important. But worst case, you'll learn about the market, you'll learn what they're thinking about, you'll learn how to maybe modify and adjust your strategy based on their strategy. There's lots of peripheral benefits to having strategic flow and thinking about those dialogues. Being the biggest isn't a requirement for being the best. Even though you're small, you can still be the North Star of your sector. So when strategics look out at the world, they think about who's the leader in this space, who's the one who has the best vision of the future. They're not as worried about scale all the time. Sometimes they are, but scale is a piece of the puzzle. They're worried about quality, and they often believe they can bring the scale. They have customers, they have the reach. What they're interested in is who has the best vision of how the world's going to unfold. And the interesting part about that is the future is actually malleable. You can impact the future. You can set the narrative. You can frame the market. You can say this is what's important in this category. Here are the things everybody needs to be thinking about. Here are the things that need to be discussed. You don't have to fit into the narrative that's being created out in the world either accidentally or by somebody else doing it. You can actually say, here are the things in this new emerging category that people need to people need to be aware of. And those things can also fit pretty tightly into your strategy. So create that narrative, structure the way the world is considered in your sector, and then be the shining light in that sector. Be the one that people think of when they think, we need to be thinking about this. Who's really done a big body of work in that area? It's so-and-so, or this team. And be that North Star, because it will move you up and create, again, the opportunity for inbound interest. Join the industry conversation. So to follow that on, lots of ways to be. I think I've made this point a couple times already. Be in the industry conversation, be known, be aware, be active in the dialogue. And then be ready. So if you're going to be in the business of creating inbound interest, be ready to activate it when it comes in. Know how to develop the economic thesis. What does this mean for them? Have your back office prepared. I know it sounds boring, but just being able to do a deal is actually something that can take weeks and months. If they say, hey, we want to do some due diligence on your main customer contracts and your corporate formation and your employment agreements and all these back office things that sound sort of insignificant. They're not, because it can take you weeks to get all that crap together, and it'd be better if you already had it done and organized, and it's not that hard to do. So understanding how to receive the inbound interest, understand how to have that conversation, have a narrative prepared that's going to be an idea-forming narrative, have the supplemental information they're going to want. We already know what they're going to be after. Have that ready, and then have your back office ready as well, so that when inbound interest comes and those circles do align, you don't spend a month or 6 weeks just getting your act together to be able to close the deal. Good deals happen fast. Be ready to move at that pace. And then anticipate the startup idiosyncrasies. These deals are complicated, they're long, they're very people dependent, they have lots of twists and turns. Read the book to get more on these dynamics. There's a whole back half of the book is basically around this stuff. But they don't close in a straight line. And a term sheet is not a deal. It's very far from a deal. In fact, in some ways, a term sheet increases the likelihood you're not going to get a deal, because it creates behaviors on the buy side that could drive you away from a deal in terms of them sort of relaxing and once they get you locked up and maybe even thinking about other opportunities. So in some ways, some of the steps that bring you closer to close perceptibly actually take you further away, which is, again, an idiosyncrasy of the nature of startup acquisition. So I'm rushing a bit because I want to get to questions. But the ask point would be, be optimized. If you do things the right way, and you think about some of the concepts we talked about here, and you approach things in an open fashion, understand the idiosyncrasies, you can actually have a better shot at optimizing your deal, increase your own flexibility, and create more dynamism in how you're going to approach things, and you can actually get things done faster. So if you have a frame of reference that actually is relevant to how startup M&A works, you can substantially increase the likelihood of success, and you can actually use the things that when you look at those first few slides, be like, oh boy, this is really hard and complicated. You can actually flip those around and use those same dynamics actually in your favor, and understand the cadence of these transactions is different than the cadence of other transactions, and optimize the way you go about doing them to match how the actual dynamics work. I think I'm done clicking. So thank you. Go Bears. This is a transaction a great opportunity for to be part of the Haas community, and it's terrific that they put these sort of lifetime learning events together. So I'm happy to answer some questions. I hope that was helpful, and I would love to hear from the startups in the community if you have any questions. Looks like not a whole lot, but there's 3. So, first one. Kevin's getting them for me here. Take a sip of water. You're welcome, Carter. You were great. Thank you, my dear. What's the best way to deal with exclusivity on a term sheet if there are others interested, if you don't want to kill the other interested party while you move to close? This is a great question. So first off, I'm not a big fan of exclusivity. And not because it's not necessarily just bad for the seller. I think it's bad for the buyer too. I think that the exclusivity oftentimes is a symptom of trying to accelerate a relationship before it's really ready to be accelerated. And that that if you take, as I said before, a slightly slower cadence to the relationship, you can change those dynamics. So here's a few tips, and they're actually in the book too, at the very back on term sheets. The first is confirm that the buyer is engaging, the buyer, your buyer one in this case, the one who's actually at the table, is engaging in what I will call confirmatory, not exploratory due diligence. Do they really have a developed thesis? Do they really understand why they're doing this deal? Do they really have a clear handle on the company itself? And so one of the things you can do to buy yourself a little bit of time is advanced due diligence. Say to them, hey, look, I really want to make sure you're clear on these things. Have you looked at these things? Do you understand what we're doing? You know, your option agreements, your corporate formation, some of your material agreements. If there's something really secret, then keep that to the side. But most of that stuff's like, it's the same, everybody's got the same stuff. So just have them review all of that. It'll also give them a greater confidence in that this is a very clean company and there's not, some litigation monster in the closet that they have to account for in thinking about this deal, or there's not you're not licensing all your technology from some third party and you never told them that. And if you are, and if there are any of those things, you better get that out now anyway. So you do have some dark secret, better just put that on the table and figure out how it impacts the deal. It's all get priced in the deal or kill it. But the reality is advance those conversations as far as you can before you get to the term sheet and an exclusivity component. That will enable you to then have other conversations in parallel and determine if there's a different deal that maybe fits your needs better. And I say different versus sort of better because different has a lot of components in this business. I mean, it's very team dependent. It very much matters on where people feel they're going to both have the opportunity to flourish and flourish individually. Tactically, I'm not a big fan of, if you do have to end up doing a term sheet, not all one size term sheet fits all. So how can you structure this? So first off, how do you put a timetable in the term sheet? Say, hey, look, if you don't get to a draft of the definitive agreement in 2 weeks, term sheet expires. Create some tempo on their end. The exclusivity expires. Have them agree that if they change a material term, the exclusivity expires, or if they intend to change a material term. That's a bit like truth serum. It's tough to fully control for that, but at least gives you something on your side of the table to say, hey, you knew 2 weeks ago that you were going to drop the price by $10 million, and you didn't tell us. And that's important. So they have 36 hours after determining to change a material term, they got to let you know. And if they don't, term sheet's expired or should have expired. Again, you're trying to get them to move. In my experience, once a buyer gets the actual attorneys involved and is writing the definitive agreements, you're pretty much on track to close. But that death zone is the zone between when you sign a term sheet and when they get lawyers working on definitive agreements, where they're still figuring out if they want to do this deal and going through buyer's remorse, and somebody from across the company said, my cousin has a company that's just as good and we should buy them for half as much, or whatever it may be. That's the problem that you want to make sure you move through and don't lose momentum on your transaction. You want to, if that's where their thinking is, go off and buyer and have that thinking, but don't lock us up while you're trying to figure out if you want to do the deal. So in the book, all these things are said, but definitely structure it, avoid it, advance your due diligence to push it as far as you can late in the process, and then structure it if you have to go into it. So I hope that answers your question. All right. That was you, Carter, in terms of that question. Vikas, question for you. If a startup goes the route of hiring an investment banker, what qualities would you look for? Should you focus on the banker that has relationships with potential acquirers that you haven't been able to reach on your own? Should you look for success in closing deals and getting the highest price? All great questions. I'm an advisor, so I generally recommend in many cases, or think in many cases, advisors make sense. I actually have a bit on the book, actually as well, at the very end about what you should look for in an advisor. So definitely flip to the very back on that. And when one may not be relevant. First and foremost, the number one quality you want in your advisor is, can they tell your story? Because the value of these assets, because the value of a startup is so much in the future, so much of it is what will happen, not what has happened. And a challenge is many investment bankers come out of finance, which makes them great for kind of Wall Street, late stage transactions, dueling EBITDA multiples. The challenge in startups is it's about products, it's about things that haven't happened yet, it's about the future. And so what you really need, if you're gonna get the leverage of an advisor, is first off somebody who knows how to help you tell your story and knows how to help you articulate that story to extract maximum value and create maximum value in the market. So, loosely said, domain expertise, loosely said, storytelling. But if that person or team of people can't help you tell that story, you're not going to get maximum value. In parallel, relationships are important, as you asked. Nobody knows everybody. I know a lot of people. I don't know everybody. And so having somebody that has a relevant set of relationships is good. It's not critical. Usually someone who has domain expertise is going to have some set of relationships, but you do want to have some core set of relationships that you can leverage from that person. But a good deal will get looked at if it's presented the right way by almost everybody anyway. So it's not critical. And then thirdly, I would say deals and companies like yours. So, and not so much in the sector, but the stage and style of deal. Startup acquisitions are quirky. And so if you don't understand how they click together, and you don't understand how these transactions unfold, and you just haven't done a bunch of them, or haven't been around a bunch of them, it's its own learning curve. So you want to have an advisor that can help you tell your story, some relationships, but definitely relevant contextual domain expertise, and has done deals like yours. Now, extracting highest price, all that, who the heck knows? It's very hard to know in these deals what could have been the highest price, what the value of that asset really was. But have they successfully completed some deals? And do they have the understanding of the nuance of these peculiar transactions? That is things I would look for. Okay. Highest price. If the startup has multiple suitors, should you make them aware of each other? If so, how do you do it without being too aggressive and turning them off? We just started DD process with both suitors. Well, first off, I think you did one thing nice, which was start DD process in advance of getting Tiffany into an exclusive term sheet. So I think you're already playing the game well, and you're not turned off from talking to two. I'm not a big fan of playing folks off each other. It can work, but I would generally say develop each conversation independently. Have confidence that you can push each one to the outer limit of what you think each one can do. But multiple things happen when you try to collide these two buyers together. It may feel like that's how people do when they do deals, but it actually doesn't work that well. First off, as soon as somebody else knows that there's somebody else looking hard, they're going to try and lock the other guy or person, gal, out. And that's bad for you because it decreases your optionality. And it's unlikely you're going to see significant changes in their thesis because you're probably worth slightly different things to each one, is my guess. May not, but I'm assuming so. And so the longer you can keep them both independent, develop them both as far as you can, and find out which one you like better, and then end up trying to basically move to close with the one that moves the fastest. So it sounds like you're already off to a good start, but I would develop both those conversations. Don't try and lean on competitive dynamics, but lean on confidence dynamics to develop the price as best you can with each one, and the other terms as well. It's not just price; it's lots of other things go into one of these deals, and then try to close with the one you like the best. The other problem, by the way, with competitive dynamics, as I mentioned before, is timing. It really screws up your timing. If they're not moving at the same pace, or one has more questions they need answered, and you start to clobber them together, you'll just have a timing problem with them. I hope that helps. This is great. Thank you, Jenna. How many potential buyers do you want to keep warm? That's a great question. I guess it matters where you are in the process. It's hard to manage buyers. So if you're having conversations with 20, it's like how you have time in the week to develop a real meaningful thesis with 20 buyers. So I think just the normal startup team, you really can't handle more than 3 or 4 meaningful conversations at once. Have folks who are aware of you, have folks who maybe could be relevant to you down the line. But in terms of active conversations, I think the sort of diminishing returns and the degradation of time you're going to have to invest in those relationships is significant. And so you're better off picking a narrow band, 3 or 4, maybe 2 to 4, that you can really develop the thesis with, versus trying to spread yourself really thin and get lots of people engaged. John Courtwright, I'm in the process of selling a firm I'm invested in. I've been through startup sales process before, but I have not dealt with the situation before the buyer. We see a very good fit. The price is reasonable, but the buyer's delayed the transaction for 45 days. We asked them for the reason for the delay, and they answered short-term validity, need more due diligence. It's a hedge fund. We didn't think it was liquidity, but now I'm starting cash shortage. That's a tough one. First off, financial buyers are tricky with startups because they don't bring anything except for cash, as I mentioned before. So if they're buying you to acquire it, to operate it for their own independent growth purposes, and they have a liquidity crunch, you're sort of like twice hit, as you've surmised. That's a tricky scenario. And also developing that conversation is tricky because you're in a dynamic where they're sort of doing this as a portfolio of assets. It's not something they have to do right now. There's other assets they could own later. So I would probably find a way to understand and have conversation with them about what the parameters are for them re-engaging. And frankly, I would also, again, I don't know that I'm giving you on one paragraph of interest. I would advance the due diligence so they have no excuse for taking time. I would try to understand the strategic thesis for what motivates them. And I would also have a pretty shrewd assessment of the reality that this doesn't sound like a high probability one, because there's nothing unique in their thesis that requires you. It's just an investment thesis from what that said. I don't know if there's another part of their platform that could leverage you or something like that, or maybe they're buying you to operate their hedge fund. But the challenge is that with a financial buyer, they're very tricky because A, they don't value very high because they don't have anything they're bringing, and B, you're just a portfolio of assets to them. It's not another compelling higher order reason for buying you. Okay, any other questions? Is that it? That's it. Look, we're at time. I hope this was helpful. We really, at Haas, I'm the former president or chair of the Alumni Council. This is all about the value of your degree. This community, it's not about what happens before you're in Haas. During Haas, the best stuff happens after Haas. And so we want your time, talent, and treasure. We want you to give back. We want you to participate. We want you in the Haas community, and we want you to find ways that you can be part of this. So we would love to get to know you better as well, and hopefully things like this help fulfill the values that Haas has. So thank you all. Go Bears, and look forward to having you around. And most of what I discuss is covered in the book in more detail. So if this is up your alley and you're dealing with these situations, it's a quick read. Try to make it fun and flick through it really fast. And worst case, hit me on LinkedIn or something if you got a question you want to discuss.